I find this very interesting because we are seeing developed market central banks hiking really fast or trying to in order to rein in inflation. But why aren't Asian central banks also catching up?
Yes, it's a very interesting observation there, isn't it? So countries like Thailand, India and Korea have been drawing on vast reserves, basically selling the dollar to prop up their currencies. Combined, they've sold about 115 billion so far in US dollars to halt their currencies decline. They have been raising rates, to be fair, but it's nowhere near as fast as peers say in Latin America. And economists, though, say that selling dollars, doing the path that they're doing, is actually key to tackling inflation, even more so than, say, narrowing the rate differential with the Fed. So key to all of this is wrestling inflation under control. By tapping the FX reserves, these central banks are showing that are hoping basically for a shallow hiking cycle, and that will be enough to just stave off a recession.
Well, your recession signal, if you will, is still that inversion of the Treasury yield. That deepened, actually, the curve on Wednesday. The market, again, proving pretty volatile in this respect. So what is this telling us at this point? And are people worried about this particular indicator?
Absolutely. It is being closely watched right now. So the gap between the 2 and 10-year part of the Treasury curve shifted to a fresh extreme, about 37 basis points, 38 at one point, and it's a level that hasn't been seen in 22 years, basically. So it is closely watched, not just by bond traders, though, but economists and other investors, as well as a potential signal for a slowdown. The gauge is telling us right now that the Fed is going to hike and hike aggressively. Inflation is at the forefront of their minds, and they would hike at all costs. And that's why the long end, the 10-year part of the curve, isn't climbing as aggressively, say, as the 2-year part of the curve, which is more sensitive to interest rate movements. And people are buying bonds because they're worried, and treasuries remain a key haven.
Yeah, what is the bond market telling us? Because the U.S. junk bond market seems to be forecasting that the economy could weaken, but not necessarily slip into recession.
Isn't it an interesting dichotomy there, isn't it? Two parts of debt markets telling us two vastly different things. So on one hand, you've got rates traders saying a recession is coming. On the other, the junk bond market in the US, is showing that things are the other way around. Investors are voting with their dollars. Junk bonds gained nearly 6% in July, the biggest one-month rally in basically a decade. So it's still rising so far this month as well. Risk premiums of the bonds stand at levels not usually linked with recession. That's what we're seeing. So for now, it seems like people are happy to buy risk assets, and recession, at least for junk bond traders, are not top of mind right now.